Hey, what's up, stock compounders? Brad here. So today we have our weekly Q&A session. We've got a bunch of great questions for you guys today. So let's dive right in. So the first question from Investing with Frank. Michael Rosenblum from Bonsai Partners in his recent investor letter discussed Micron and said it has reached fair value and that he will be cautious moving forward. For context, Michael has 12% of the portfolio in Micron and had returns of about 250% year over year. How are you thinking about Micron valuation currently? And what type of holding period are you looking at? So let's check out the letter that Frank is referring to here. This Q4 2020 letter to investors. So you can see Micron right here. Let's kind of quickly glance over this. So Micron shares significantly appreciated this quarter four, for a couple of reasons. The DRAM market appears to have begun its cyclical rebound. We will likely see higher pricing and profitability through at least the calendar year 2021. Another driver was that semiconductor stocks have become en vogue once again. I may not be old, but I've been around the sector long enough to know that when generalists start getting excited about a new paradigm around semiconductors, it's time to be wary. I wouldn't call Micron overvalued, but I'd certainly say it's more fairly priced today compared to when we first purchased it a few months ago. So that's what Rosenblum has to say. If we do kind of a strict DCF on Micron, based on kind of the underlying fundamentals today, it's pretty reasonable that we come up with pretty close to fair value for Micron. However, Micron is not something that I was trying to buy for 50 cents and sell for $1. Micron I do see as a long-term compounder. So I have no plans to sell at fair value, even optically overvalued, as Monish Pabrai likes to say. So, I'm loving what Micron has done since I bought it. I bought it around $35 per share. I think it's like $84 per share now. So it's had a fantastic run, but I'm going to hold on to it. It's probably better for me to not even look at it, okay? Li Lu owns it. I think Li Lu got her in probably around lower $40 per share. Pabrai got in around $38 per share, kind of average share price. So, basically until one of those guys sells Micron, I don't even really need to look at it. That's kind of how I'm thinking about Micron. And hopefully it can be one of these companies that I hold for a decade or more. That would make me very happy. So, valuation-wise, it's not something I'm really doing. I don't feel any need to try to value Micron today, because that's not my approach to this holding. My approach is to buy it, stick it in the coffee can, and if the story changes, if Pabrai or Li Lu get out, that's when I'm going to kind of reassess where things are at. So that's that one. Jake, thanks for doing this. Any update with respect to your thought on Shinnikin Group? I'm liking it more and more. The only thing holding me back is the stability of the free cash flows and the fact that it seems that the management team may be stretching itself too thin by taking on too many different projects that are outside the core competence. Okay. So Shinnikin is a video I made a video about Shinnikin a couple weeks ago. It's Pabrai's, I think, his only holding in Japan currently. And it's a real estate play. Pabrai seems to be really big on real estate companies right now. He's got real estate in Turkey. He's got real estate in India. Obviously, Seritage growth properties in the U.S. So I haven't dug too deeply into Shinnikin group. If you guys want to read basically what I've read, check out my video from a couple weeks ago on Shinnikin. I linked to a couple different write-ups in the description. But it's not something I've gotten too deeply into. I've just had other things to look at in the meantime. But I do plan on going deeper on Shinnikin because, I think it could be a great long-term compounder potentially. So more on that soon, Jake. Sasha, hey, do you think magic formula stocks with a high return on invested capital should be held for a long time period, and acquirers multiple stocks that are just cheap should be sold much faster? How do you decide when to sell? It's a great question. So magic formula stocks, as many of you probably know, are really based on a combination of two metrics, right? Earnings yield, which is a measure of how cheap a business is, and return on invested capital, which is a measure of how good a business is. So the magic formula kind of combines cheap and good, whereas acquirers multiple just focuses on the cheap stocks, the companies with the best earnings yield. So yeah, it makes sense to me that if you're going based on both cheap and good, it could make sense to hold those longer, right? Because if it's a good company, there's potential there for a multi-bagger, right? A kind of set it and forget it, a long-term compounder type situation. There's that potential there. Whereas with straight acquirers multiple companies, there's probably less potential for that kind of situation. And all you're trying to do with the acquirers multiple is get in when it's cheap, let the market kind of revert that price back to the average, reversion to the mean, and then get out. So that seems to make sense that you would hold acquirers multiple stocks for maybe a year, which I think is what Tobias Carlyle recommends for that. And then my kind of tweaked magic formula approach is to hold for 2 years and then kind of reassess, not to automatically sell after 2 years, but to decide at that point if it's a company that's worth continuing to hold or to get rid of it and make room for another magic formula stock at that time. So, what you're alluding to here is kind of along my line of thinking, that magic formula might make sense to hold them longer than acquires multiple stocks. How do you decide when to sell? I think the best way to decide when to sell for magic formula or acquires multiple is to stick with the system, right? Decide in advance when you're going to sell, rather than, of course, I'm not quite following this with the magic formula, but rather than allowing your biases to come in. And it just incorporates the need to make more decisions, right? If you don't have these kind of fixed rules up front about how you're going to enter and exit positions. But, in fairness, basically the same rules that I'm using to select my magic formula stocks are the same rules I'm going to use after 2 years to decide whether or not to continue holding or to sell out of those. So if you want to learn more about how I decide, actually I haven't talked much about how I'm going to decide when to sell for the magic formula portfolio. I've only been doing that for a little over 6 months now. So I've got time to figure out, to really kind of refine my sell process there. Would you actualize your thoughts on Spax as a cash alternative? Okay. I was reading your posts in Corner of Berkshire and Fairfax, pretty interesting. Do you think it is risky in the actual frenzy environment? If we are in a SPAC bubble, how do you think it could finally pop? Are there any of them to come in the next months you think are interesting? So talking about SPACs, Sam Zell actually just put out, he did an interview with CNBC. He talked a little bit about SPACs in there, and he was asked straight up, like, back in 1996, 1997, Greenspan said, clearly there's kind of market euphoria happening. But it took 3 or 4 years for the bubble to finally pop. So there's a real danger in sitting on the sidelines, even when we know that there's clearly some very speculative activity going on in the markets. But getting back to the direct question, so here's what's risky in this environment with regards to SPACs. It gets risky when you buy significantly above the net asset value of a SPAC. Okay, so say net asset value is $10 per share, which is usually the case with a special purpose acquisition company. If you're buying at 15, say before a deal announcement or something like that, you've got a fair bit of room to fall back down to the net asset value. And that's exactly what's going to happen if, the market tanks, right? If we enter kind of a market crash situation that we had last March, those are going to fall very quickly back down to net asset value, maybe even below net asset value. So if you can buy in close to that NAV, I think that's really how you control risk in SPACs. There's one that I'm in that's still pretty close to net asset value. It's the Oak Tree SPAC, OACB, I believe is the ticker. So check that one out if you're interested. Obviously, this is not investment advice, but that could be an interesting one to look at. I have no idea how it's going to finally pop, right? Nobody knows how it's going to pop. All we know is that there's a lot of speculative activity in certain areas of the market, and it's hard to imagine that activity is sustainable, that it's not going to come back down to earth at some point in the near future. Now, how you define near, I will leave up to you. Would like to know your thoughts on Turtle Beach. With no debt and strong expansion plans, I think they offer remarkable returns. So I think Jack Duffley did a video on Turtle Beach. The ticker is HEAR, HEAR. Turtle Beach is a company I bought through my Magic Formula portfolio. I think at the end of December, I bought Turtle Beach. And that was purely based on kind of a quantitative system that I'm using with the Magic Formula stocks. So I didn't go deeply at all into Turtle Beach. But it's done well. I think it's up like 45% since I bought it just a month and a half ago, which is great. But I don't have any particular insights. Again, check with Jack Duffley, Duffley. I think he put out a video on Turtle Beach. But it's a company that makes basically headphones for gamers. I think that's their kind of core business. What is your annualized return for the past 5 years? Any lessons learned from past failures that makes you a better investor today? So guys, I'm a little embarrassed to say this. I have no idea what my annualized return is for the past 5 years. And I don't even know that, if I had to guess, I'd say it's probably not super compelling. I've really only been investing for 5 years. And this channel is really, the kind of core goal for this channel is to help me become a better investor. To, as I learn different concepts around investing, to teach those concepts, to really ingrain those and help me figure out, where there are holes in my understanding through the comments, through saying things out loud and then realizing, I don't actually know a piece of this. There's something missing. So I'm really not here as your guru. I'm not here to say, hey guys, I'm crushing it in the market. Here's what I'm buying. You guys should buy these things as well. That is not the purpose of this channel. It's really to grow as an investor, hopefully grow alongside you guys. Hopefully we can learn together. I'm really enjoying kind of the community aspect of this channel and similar channels like it. So, lesson learned from past failure. I think the big lesson I would say, well, I mentioned in the last Q&A, I bought leaps, which are long-term call options on Fiat Chrysler, and those didn't work out. I thought, I thought I was outsmarting, myself by buying these leaps where I've got potentially a lot more upside if it goes up. But what I didn't factor in enough is if the price goes down of the common, of fiat stock, the leaps are going to expire, right? Eventually they're going to expire. And if the stock hasn't gotten to a certain price by the time those expire, I lose all of the money that I put into those leaps, those options. So that's a lesson that I like to remind myself of when I want to get to the promised land faster than I think I can by just buying straight up stock. Okay, that's really the way to go, in my experience, is to have the patience to buy the right businesses. Think of myself as an owner of the businesses, and let those businesses make me wealthy, right? So that's the key there. Hi, Brad. I'm sitting at 65 to 70% cash, but I continually struggle to have conviction to create a large position with my own investment ideas that are within my circle of competence, or any shameless cloner ideas that are outside my circle of competence. Is this something you have or do struggle with? I want to put the money to work, but struggling to pull the trigger and end up just dipping my toe in. Yeah, I definitely struggled with that for a while. There's so much to learn in this game called investing. It's hard to be in that much cash, 65 to 70%, especially when the market is doing what it's been doing for the last, almost year now. It's just been on fire kind of since last April. So here's my advice with this. The only way you're really going to learn is by doing, okay? By putting money to work. Now, there's two different approaches here. If you have trust money, or if you have a bulk sum of money that you're starting with, I would be much more hesitant to put that money to work quickly, okay? You want to kind of learn as you go before you're putting a lot of that at risk. But, if you're just putting, say, 10, 20% of your income each week, each month into investing, I would say, put most of that into opportunities, put most of that into stocks, okay? And don't be afraid of failure, especially if you're young, because when we make mistakes, when we do things that don't work, those are the best lessons, okay? A lot of people look at what's happening in the markets right now, how there's all these Robinhood investors who, probably don't have a lot of experience in the markets. And there's a lot of fear for them, right? There's a lot of fear that they're going to lose all their money, and it's just going to be a disaster. My perspective is, it's great. The earlier on in our investing careers that we can get those learning experiences where the market crashes, and we're able to kind of look at what we were investing in and figure out, all right, maybe I had too much risk. What could I have done differently? Those can be the absolute best learning experiences. So, if it's not this big bulk of cash that you got as an inheritance or something like that, I would say just start putting it to work, even though it's harder to find deals today than it is when the market is not as frothy. But still, the best learning comes from putting your money to work in the markets. So that's the best advice I have for that. And it's hard. It's probably going to be scary. And go slow. It's fine to go slow. But don't just sit on the sidelines, okay, until some crash happens, because nobody knows how long it's going to be. And that whole time, you're not going to be learning as much as you would be if you actually had your money invested in the markets. So, my 2 cents. Has your list of companies and buy price changed since you last uploaded your list of companies you wanted to own? I've probably added a few. I should do a video, kind of an update video on my current list and target buy prices. But honestly, it hasn't changed too much. So that's, I think I made a video close to when the last 13 Fs came out. If I had to guess, I would say probably like late November. I think it was, my stock wish list or something like that. So it hasn't changed too much, but thanks for the nudge. I will update that and make a video about it. What companies are you analyzing at the moment? What are your thoughts on the Magic Formula website for stock ideas? So what companies are you analyzing at the moment? I'm looking at Lithium Americas Corp, big lithium miner in South America and Nevada. Lithium is very interesting to me because in order to make this transition to, electric vehicles from internal combustion engine vehicles, and in a lot of different energy spaces, shifting to a more renewable energy economy, we're going to need a lot of certain metals, okay? And lithium is one of those. So I think there's a lot of tailwinds behind lithium. So that's one. What are your thoughts on Magic Formula website for stock ideas? I think it's great. I think it's a great place to kind of hunt for smaller, small cap, micro cap stocks that, are both cheap and promising in terms of return on invested capital. But, I think there's definitely more work to do. It's kind of maybe the top of the funnel for ideas. And you can look at my past Magic Formula videos to see which filters I apply to kind of narrow down my Magic Formula portfolio. But I will say a better place for me to find ideas, significantly better, in fact, is 13F filings, okay? Which we're right in the middle of 13F season right now. We had a bunch of 13Fs that came out today. There's going to be a bunch more that come out on Monday. So it's very exciting times. And there's actually a question below where I will mention one of those 13Fs where there was some activity in the fourth quarter of 2020. Got a business that you might find interesting, Occidental Petroleum. So it may be a great investment. Right, ESG. I would love your take on this. An oil company, but are investing in direct air carbon capture. So I don't even know what direct air carbon capture is. I'm going to have to look into that. It sounds interesting. Yeah, since there's an ESG element, I'll take a look at it. My first thought is it's a petroleum company. I'm not that interested in that. I don't get excited thinking about spending my time kind of getting to know a petroleum company. But, I will take a look, considering there is an ESG component with this direct air carbon capture. So thanks for that tip, Rick. I got some money in various ARK ETFs. I think the manager is bomb. Wrong? I think Sven Carlin did a pretty good job putting out a video on Cathie Wood from ARK. You guys, there's been, obviously Cathie Wood has had an incredible performance over the last handful of years. My big question is how much of that is her ability to identify standout companies that will, be these long-term compounders, and how much of that is the industries that she's been investing in and the fact that those particular industries have really benefited from the mania, the Robinhood mania, just the basically crazy investing bubble that we seem to find ourselves in at the moment. So, I don't know much about Cathie Wood. I don't know much about ARK. I haven't really gotten into it yet. But I would be nervous. And the reason I'd be nervous is because very often when a manager outperforms, say over the last 5 or 10 years, there's so much capital that flows into that fund that makes it a lot harder to outperform going forward. Because if you think about it, as capital flows into a fund, as it's going up and up and up, the fund has to buy the stocks in that fund at higher and higher prices, right? And as a value investor, that is not the situation we want to be in. But these funds, because of the way they're set up, that's what they have to do. They're basically forced to buy at higher and higher prices as the frenzy pumps money into these funds. So she may be a great investor, and she's definitely had some tailwinds in the last 5 years based, again, on the industries that fund has been investing in. But I think she's going to be facing some headwinds in the next 5 to 10 years. That's just my take on that. How far do you go in your equity research before buying? I believe Phil Town says, read the past 10 years of filings. I feel that is quite a bit of homework to do, but probably a good idea. It probably is a good idea. Honestly, guys, sometimes if there's an investor I really like who has bought something, I'll buy a little, right? I'll start a position without doing much work at all, right? I'll wet my beak on that company. And that will, then I can see myself as an owner, right? I own a piece of this business, and that actually motivates me to really dig in. It's more fun for me to dig in if, it's not something just that I might buy, right? It's something that I already own, even if it's a small amount. So, I would answer this. It's different for different investments, but I don't see a problem with that. Just kind of wetting your beak and then using that as motivation to go deeper. How do you go about analyzing competitors and deciding if they are inferior or superior to the company you are looking into? Reading the annual reports, the current annual, the most recent one, kind of going back, they're going to talk about their competitors. You can look at, certain financial metrics like return on invested capital, profit margins. Usually the numbers will give you a pretty good sense for whether they are inferior or superior, right, to competitors. You can also look at, revenue growth as compared to competitors. So there's a number of different things you can look at for that. What are your thoughts on stock APT? What is it? Alpha Pro Tech, I think. I looked for that on Value Investors Club and Corner of Berkshire and Fairfax, and there was no talk about it on either of those. So I didn't look any further. I highly encourage you guys, if to be very quick to say no to new investment opportunities. Okay. If you read a business description and it's not a company that you're interested in, if it's not an area, someone just the other day sent me an idea about a tax, an accounting firm, right, that gets most of the revenue for offering tax services. I have no interest in that. It's just not something I want to spend time learning about. So, APT, it didn't check the VIC box, the COBF box. I'm moving on. But, if you have more thoughts about it, Amber, send me kind of a quick write-up, and, maybe that will pique my interest. Thoughts on KO. So Coca-Cola, is it a buy at 50? I have no interest in Coca-Cola. I know Monish Pabrai, Warren Buffett talk about how it's this fantastic business. and it makes sense that it would be a fantastic business. Based on the business model. But I don't drink Coke. I know they have a lot more than sodas. They're getting into energy drinks and water, sparkling water, all kinds of different beverages. But I really just don't consume those products. So I'm not super interested in Coke. How do you think Spax will perform during a market crash? Do they fall below cash value? I think it's very likely that they could fall below cash value. There's actually a thread in Corner of Berkshire and Fairfax that I've been pretty active. I think I started the thread. Something about Spax as, upside without downside, something like that. And someone chimed in and said, in the I think it was during the global financial crisis, there were SPACs that dropped down to 80 or 90 cents on the dollar compared to NAV. And, they looked at that as a way to gauge how close we are to the bottom, okay? So say there's a crash. I think it could be an interesting way to kind of know where we are in the cycle, to look at SPACs maybe as a whole. And once they get in aggregate down to that 80 or 90 cents, $8 or $9, if it's a $10 NAV, that could be an indication that we're kind of at maximum pessimism in terms of the market. So that was an interesting thing I came across. But yeah, they're going to fall like everything else. But because they have that net asset value, they have that kind of cash floor in a sense, I don't think they're going to fall too much beneath that. Whereas if you compare to these businesses, right, that don't have cash, they have assets, right? They have operating assets. That's kind of the bulk of most businesses. Those don't necessarily have a floor, right? Those can fall 50, 70, 80%. So that's, a difference between SPACs and your typical public company. Have you learned any new investing lessons in 2021 so far? What bad habits have you got rid of or want to get rid of? So one that I tweeted about not too long ago was this tendency for me, say I buy Micron at $35 a share, okay? And say I haven't gotten my full position yet. Say I want a 10% position, but I've only gotten 5% in at $35. Now it starts going up, okay? 36, 37, 40, 45. And I stopped buying because I was able to buy at 35. And there's this little voice in my mind that says, all right, I was able to buy once at 35. I deserve to be able to buy the rest of my position at 35. I will not settle for anything less than 35. Now that is obviously a very irrational approach to building a position, but it's something I've fallen into, right? It's like an anchoring bias. I'm anchoring on my initial buy price. So that's a bad habit I'm trying to get rid of. And I think the way to get rid of it is to try as hard as possible to forget at what price you bought and simply look at, all right, what do I think it's worth today? And what is the price today? And yeah, just trying to leave behind the anchoring. It's difficult. Any other lessons in 2021? I mean, it's only been, a month and a half. I'm getting into Nick Sleep's letters, Nomad Partnership from like 2001 to 2013. That had a big influence on Monish Pabrai and how he looks for new investments. So I'm excited. Hopefully I'm going to pick up some lessons from that, and I'll keep you guys posted. Last one. Not a question, but I think Guy Spears' SEC filings 13F from the previous quarter have just been posted. He appears he increased his position in Micron. That is true. Let's just jump over to that real quick. I noticed that earlier today. Guy Spear, and I'm going to make a video kind of going through the investors that I like to clone the most, and kind of talk about new positions or position changes for you guys pretty soon. But I did notice a change for Guy Spear. He added to Micron. He added 2/3 to that position. Okay, so a significant increase. So I think before he had 120,000 shares, bought 80,000 in the fourth quarter of 2020, and now he has 200,000 shares. So, his sixth largest position at the moment. So yeah, that's encouraging to see. I respect Guy Spear as an investor, and so it's always fun for me to see investors that I respect buying, adding to their positions that I own. It's fun to see that. So that is true. He did add, and like I said, I will be putting out probably a couple videos on, the super investors that I track most closely, what they did in the fourth quarter of 2020. So that is all, guys. Thank you for those awesome questions. I feel like every week the questions get better and better. Probably next Thursday, I'm going to post another, dropping a Q&A session tomorrow. Leave your questions. So please keep them coming. This is a lot of fun for me. And I will see you all in the next video. Take care.